Last week we got the jobs data point and it came out kind of mixed. I would argue a little bit more sour than sweet, but the jobs data was just the start. This week we have CPI, which ramps things up as we get ready for the official meeting next week where the Fed is expected to cut interest rates for the first time. In this video, I'm going to be breaking down what the risks are in this market because I do think that they are pretty substantial as we go into inflation week. Now, CPI doesn't have the same terrifying weight that it did in previous months. Now, jobs data seems to be more important to the market. However, inflation still has the slight chance of causing some serious volatility in the markets. Let's get ready for the week ahead and talking about trading setups. I'm also going to share a couple trades that I'm actually in myself, and we'll jump into it right now. As we get started today, guys, I just want to ask if you could please hit that subscribe button if you're new to the channel and hit the thumbs up button if you have not already. And I want to talk about something that we just launched, which is really exciting. Some of you guys might recognize this guy. This is Chris Pulver, and we just launched a service together where you can see the trades that he is sharing within the A1 Trading Discord channel. Now, if you don't know Chris is a 20-year trading veteran. He manages money for people all over the world, and he has a very solid track record of growing accounts over time. And the reason I bring all this up is that Chris and I have done live streams together for, a while now. And after a while, we decided, hey, it would probably be cool to go ahead and kind of blend and work together within our Discord server. So Chris trades everything from FX to indices, commodities, options, etc. And many of you probably know him already from the shows. He's very experienced. He's done this for a long time. He has a lot of skill at what he does. And if you'd like to get access to the Pulver alerts, we're going to be using a link in the description down below. The first link in the description will allow you to chat directly with a member of our team and get set up with the Pulver alerts service. And it is 35% off for people who are watching the videos right now. So if you'd like to get 35% off as we kick off this new service, you can get access to all of Chris's trades. Again, there is no nonsense here because Chris is a real trader. He shows live accounts all the time in our videos, and I have a lot of respect for him. So check out his service by chatting directly with a member of our team or heading over to our website and going to a1trading.com/pulver-alerts. So today I'd like to start by taking a quick look at the indices, which are kind of up. They were up a lot this morning and have been giving back steadily some of their grounds this morning. If we take a look at a 5-minute chart, that's very apparent. You can see that going into the start of the day, we had a big move higher on the indices and then followed with the kind of New York Open topping out and seemingly showing some signs of selling pressure coming into this market. Now, personally, I don't tend to short indices very frequently as it's a really tricky trade and your timing has to be just right. The way indices typically move over the long term is they typically trend slowly higher, and when they drop very violently and very quickly. So if you're somebody who is good at timing or very good at timing, the indices can be your best friend on the short side. But timing has always been something that's a little tricky for me. That being said, in a rare occurrence, I actually went short on an index today, but it wasn't a US index. So I didn't short the SPX, I didn't short the NAS, I didn't short the Dow. Gladly I didn't short the Dow. The Dow's really killing it today. I actually ended up shorting the Nikkei 225, which is the Japanese stock market here at the start of the day. And I'll show you on the 4-hour chart where I took this trade. We can zoom in a little bit. So I actually shorted this directly on live stream. The market opened up and I decided I'd like to take a small stab at shorting the Nikkei. So if you guys remember last month around when jobs data was kind of weak, the Nikkei actually sold off aggressively. And if we take a look at from peak to trough, what happened there, you can actually see that the Nikkei started selling off, was down 10%, then 15%, and actually even went all the way down to 27.5% down in just a very short few weeks. Very aggressive selling. And recently we've seen, again, a bit of selling coming back in. So after this big resurgence, this big rebound in the Nikkei, we saw some sell pressure start to pick up. And with the bounce back this morning, I decided that I have a pretty good risk reward trade here. If I'm dead wrong about this and the Nikkei is just flying up by the time you guys see this video, then I will take a small controlled loss on this short position. And maybe I'll reevaluate a possible secondary short attempt around the 37,100 level for the Nikkei 225. But if we see this thing roll over, the beautiful thing about shorting indices is if you are right about it, very quickly you can get some very good risk reward trades going. Again, tricky to time, but if you get it right, it can be very highly rewarding. So again, probability wise, I'll probably take a small loss, but if I'm right here, we could have a nice winner on our hands, which would be great. So I'm watching the Nikkei, and the reason I took this trade was because it actually popped up on the Edge Finder's top setups page. We got a bearish reading here, and I do like whenever I see confluence with the Edge Finder and a price action setup, as I just showed you, that pullback into a level of resistance. The trade was there, and again, we'll see how this one plays out, and if I'm wrong, I'll take a small loss. The dollar index still is seemingly trying to bottom out here around the 100.6 level. You can see we tapped back one more time into it before shooting off of that low on Friday, and I think the reason here for this was people were a little bit confused. They were like, well, didn't we have a bad jobs data print? Shouldn't the dollar index be lower? And the jobs print was not great, but it also wasn't totally bad. Let me show you. So if we zoom in over here, what we can see is, in fact, there was a disappointment on Friday if we take a look at the actual number of jobs that were added compared to the forecast. Additionally, the yellow line here and the revisions that show here were revised lower. So that actually tells you that not only was it a not great jobs ad here, it also revised the previous month's bad numbers even lower. So that wasn't great, but then there was some redeeming factors here. If we take a look at unemployment rate, although it has been trending up, it took a pause here and actually improved slightly down to 4.2%. It's not a huge improvement, but at least we're not seeing unemployment just skyrocket further up in the latest. So that was a little bit of a positive. So there was some mixed data points here, so I wouldn't call it all good or all bad, but the market definitely took that as not good enough to keep selling the dollar hard. Maybe we're just going to consolidate and go sideways for now. This week, we have the Consumer Price Index, and CPI has the potential to move this dollar index quite a bit. So if you're watching indices or gold or currency pairs, this could be a big week, because if you get CPI very strong or very hot, meaning a higher than anticipated inflation read, the dollar index very well could be finding maybe a longer term low around this 100.6 level. And perhaps we go back to retest levels of resistance that we've seen in recent months. But if the CPI comes in very weak, it's very likely, in my view, that you would see a taking out of the low. So if the dollar index is going to continue trending lower, I think it comes down to CPI. And if it's going to make a reversal, it also comes down to CPI. So again, if we get a higher than anticipated inflation rate, what would that do to markets? Well, yields would probably rise on a higher than anticipated inflation reading. Remember, we have both the consumer price index, the CPI, and we also have the producer price index this week, the PPI. So both of these inflation reads come out this week. And if you get hot inflation, let's say that the summarized view of inflation is higher than anticipated, a surprise. What that could indicate is that, again, the Fed will still likely cut rates this month, but perhaps the forecast for future rate cuts will get slashed, meaning, again, interest rates the yield here on the 2-year Treasury bonds would actually go up. That's how that generally works. And so if you get that sort of scenario, what could that do to the dollar index? Well, it would also push the dollar index higher, as people would kind of look to the dollar and say, hey, I can get yield here longer, so maybe there's a little bit of value in the dollar. Looks like inflation might be bottoming out. So the Fed has taken its eye off of inflation recently, but if inflation does flare up again, the Fed may be forced to reduce their expectations to cut rates and perhaps just hold rates steady for longer, which could introduce some fear into places like the stock market. Now, I've seen the NASDAQ put in a lower high here, potentially, right? I really would wait until that potentially breaks through the lows to call that a lower high, because we could just be in a chop fest here. We could go sideways for a little bit. But one thing's for sure, we didn't scream back to the highs and through the highs on the NASDAQ, and that has a little bit of cautious tone to it, I would argue. NASDAQ was up a little bit more here. We saw a big bounce here this morning, but it was probably due for a bit of a short-term bounce. I actually kind of lean towards the cautious side on this one. Although I'm not outright bearish or short on the NASDAQ and S&P, I would not be surprised if we do see the NASDAQ continue to give back some gains and retest those lows, especially with rising concerns about the state of the economy as we go into this Fed meeting where they're expected to cut rates for the first time. I will say that I lean more towards a 25 basis point cut from the Federal Reserve, which is a fancy way of saying a 0.25% reduction in the Fed funds rate, which is basically borrowing costs. Borrowing costs are expected to get lower in an effort to stimulate the economy. But there is the possibility that we actually get a 50 basis point cut. Now, why would they choose to do 50 basis points? Well, 50 basis points or 0.5% would be an effort to help the economy more. And that is why when you think about the way I said that, help the economy more, so the economy needs more help, that is where people start getting fearful of a recession, of a bigger, problematic scenario. So 50 basis points is not very likely according to the probabilities right now. And the probabilities that I'm mentioning is the Fed Watch tool, which I'll show you. We can see the Fed Watch tool has about a 73% chance of a 25 basis point cut, not a 50. But this could change if CPI comes in hot, right? I'm sorry, if CPI comes in very cool, that would increase the chance of a bigger rate cut because the Fed would have more room to cut interest rates. Remember, inflation goes if inflation is going down, the Fed has more room to cut interest rates. But if inflation is going up, they don't have much room to cut interest rates. So it's a very pivotal week here because if you get really high or very low inflation or just as expected inflation, all of them carry substantial impact on what could happen to forecasts for the market going forward. Another position that I'm in is this gold trade, which has been going absolutely nowhere for the last few weeks. I bought this thing a couple weeks ago, and I'm still floating a profit on this one, but I've really just watched this thing go sideways to nowhere. I'm up $300 on this. At one point, I was up $1,000, $1,200, something like that. But again, caught this entry back here. Price moved up, down, sideways, and it is just a chop fest. It's really not the prettiest chart to look at, to be honest. Take a look at the 4-hour chart. It's just back and forth. I am still waiting, personally, for a decisive move above or below this consolidation zone from a price action standpoint. So if we see a big break through the lows and we take out the lows, I'm going to stop out of my position. And if we see a nice breakout, perhaps on low inflation numbers, meaning the Fed could cut rates aggressively, then I like the idea of staying in my gold long. So it's really just I'm just waiting and seeing what happens with price action and with the consumer price index figure this week. Euro dollar is still pulling back here, putting in a potentially lower high. If you take out these lows, that would be a bit concerning for short-term price action. Perhaps we're headed back down to the 61.8% retracement, and I don't currently have any bias on this one. I was looking for longs, but currently if I go to the top setups algorithm, you don't see euro here, so gonna kind of stay on the sidelines for this. Pound US dollar, same thing. Taking out the lows, potentially putting in a lower high here. Dollar yen also trading near its lows, and this is another concerning thing about markets. If you see the dollar yen break through those lows, it could lead into a bigger flush lower and risk off kind of taking center stage, if you will, in this market. I'm waiting for setups to appear on the top setups algorithm. I mentioned this earlier, but the top setups page basically takes into consideration a lot of economic data and generates bullish and bearish signals that I then use as complements or confluences to my own trading strategy. If you'd like to get access to the Edge Finder, there will be a link down below in the description to purchase it. Or if you'd like to try it for 30 days, there is information there as well for you to find out more there. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now, you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.